Hello and very warm welcome to this edition of the Mutual Fund Eye. My name is Vandita Shivle and I'm here to take up your queries. Today the query is coming from Shrikant. He's from Madurai, by the way. And his question is that he wishes to invest in index fund, but his advisor is advising him to stay close to active funds for better alpha. Do you think, Vandita, I should follow his advice? Okay, Srinath, I'm gonna help you with this. But a couple of things here. Had I been your advisor, I wouldn't have given you this suggestion. I know why your advisor told you to stay close to active funds. For people who are not aware, index fund is a category where fund manager does not manage the fund. It's a passive management. It's a passive strategy, basically what index funds use. This particular category uses in mutual funds, whereas the other funds like large cap or small cap funds or mid cap or multi caps, these are active funds because a fund manager is managing the particular fund, right? So that's the difference. There are other differences also which we're gonna discuss, but for people who didn't know. So coming back to your question, Srinath, what I feel is that I know why your advisor has given you such an advice, but I don't think that's a very wise way of going forward. See, diversification is very important, and I feel that with index funds, I've always said that if you're a beginner, or if you're not very well versed about the market, if you do not have those kind of great fundamental attributes, you do not understand which stocks to buy, which would be next multi-baggers, those kind of things do not come in your mind. Either we allow fund manager to do that, and that's why we always tell people to go for mutual funds and not stocks in particular. But even in mutual fund categories, sometimes when the markets are not doing well, and a lot of funds, not a lot of categories do not do well, at that time the returns are already low. But when you have an index fund, the best part is that the expense ratio reduces, right? So overall returns, they are much better. So that is why I always say index funds are important when it comes to creating your portfolio, whenever you are diversifying your portfolio. So I don't think that it's a very wise way, but let me tell you why many advisors and a lot of people, they say active funds are better, and why index funds are not that popular in India. That's very true. In US, if you listen to talks of Warren Buffett, he's a great fan of index funds. He keeps telling people that you must have index funds in your bucket. But the thing is, we need to understand couple of things here. Why we should not only stick to index fund, and why diversification is important. See, why do you choose active fund is because you want to outperform the market. You want to beat the market, right? If market has given me 10% return, you want your particular fund to give more than the benchmark, right? More than that particular the market, and that's what is outperformance. You want to beat the market, basically, and that is why people choose active funds. That's number one. Number two reason is that active funds, they have in India, they can have 35% of cash, right? They can keep 35% of cash in form of cash, the money in form of cash. So what happens is, when the market goes down, the fund manager, they have the leeway to actually use that phenomena. When we say buy in dips, so they can use that particular cash, but that kind of thing is not available when you talk about index funds, because they actually mimic the benchmark, whatever index it is benchmark to. For example, they stay very close to that. For example, if it's a Nifty 50 index fund, then the way Nifty 50 will perform, that's how your fund will perform, right? But no, it's not possible always. And because a lot of funds, lot of in index fund category itself, there are a lot of index funds which are having a lot of they are having bigger tracking error. Now, what is tracking error here is very important when you choose index, when you have to choose the index fund. So when you choose an index fund, tracking error is very important. What is tracking error? There is a benchmark index to which that particular index fund mimics, right? The fund return minus the benchmark index return, right? That's your tracking error. Whatever is your tracking error, it has to be lower. The lower it is, the better index fund it is, right? So keeping that thing in mind, people select a particular index fund. Now what happens is, we always want to beat the market, right? We want our fund to outperform, but it is not always possible. I mean, I can do it for 10 years, I can, but do you think it's a very consistent or persistent thing? And especially like the crisis that we are just facing right now in terms of the pandemic I'm talking about. It's not possible, and there's a lot of risk involved. And see, when the markets are down, at least you can expect decent returns from index fund, right? And when your total expense ratio, which is very low when it comes to index fund, when it is very less, that means your overall returns that you get are much better than what you get in an active fund. So, that's why I say index funds are a good choice, and especially for a beginner. What it does is, the constituent that you have on Nifty 50, right? The Nifty 50 index, or if it is, mimicking the Nifty 50 index, or if it is mimicking the Sensex thing. So the proportion is also same of the stocks, the quality stocks you're getting when it comes to index funds. So those kind of things really matter in such a market. When there's so much defaults happening, when there's so many when we talk about credit risk, when we talk about liquidity risk, we want to stay with quality companies. And in that terms, I would give 100 on 100 when it comes to index fund, right? Now what happens is, another reason, it's a little different from the topic that we are discussing, but why your advisor would have told you not to go with index fund was a little, I know what was in his mind, what was in the mind of your advisor. Because when you compare US economy with Indian economy, we are two very different economy. We are developing economy, they are developed economy. So the growth of companies is much slower in the US compared to India. Right here, there are more faster growing companies. And growth is all that matters, right, when it comes to market. So in order to choose multi-bagger stocks, fund manager can actually find multi-bagger stocks much easily in India compared to fund managers of US. Now, if they have to choose a company which can actually do better than market, it's very tough in US market to do that. So there's a lot of tedious work, which is it needs a lot of efficiency, and that is why in US index funds are very popular compared to that in India. Because in India, the companies are growing at a very faster rate, right? There are emerging companies whose growth is very fast, and that's why in India, active funds are more popular compared to index fund, because there are certain companies which have that kind of capability to outperform the market. But my only solution to you is, you should, as an advisor, now what do? I'm confused. Active funds are also good, index funds are also good. So what do we really do in such a scenario? In such a scenario, you need to create a portfolio which is well diversified. You should have good quantity of index funds, you should have good quantity of active funds. It should be a mixed account, a mixed portfolio, I would say. Because in index fund you can get wide variety of stock, you get immediate diversification across various sectors. I really like index funds. It's very easy, there's a Nifty 50 thing, there are, but again, here also in index fund, the kind of your risk appetite determines which particular index you choose, right? Because as I told, it stays close to the benchmark, right? It mimics the benchmark index. So if you're choosing Nifty or Sensex, it's okay for an average investor who is not willing to take that much of risk. But if you are a little less conservative and you are a little more aggressive, then maybe you can choose a small cap index, right? Or a mid cap index, or those kind of things, or maybe broader indices you can prefer over there. But what I would say is, the risk is lower in index fund, the cost is lower. I told you total expense ratio, it is very, very important. I mean, I don't know why a lot of people miss on this fact that, they just think that we can ignore the expense ratio. See, I'm not saying that the fund manager should not get his fees, but something that you can avoid, in your portfolio, you can actually add a fund which is not managed by a fund manager, and let's see how your index performs at that front. That's what is my thing. In fact, the taxes are also lower when you look at an index fund. So I would say overall the answer to your question would be have a mixed portfolio. Just tell your advisor, no, I want an index fund, because index fund is really a good choice. I always have an index fund in my portfolio. In fact, at this time, index funds are doing much better compared to my active funds. So that's what is my suggestion to you. You can actually become a market leader across various sectors if you have an index fund, right? And the quality stocks are there. That's more important here. We need to focus on quality, right? And I can recommend you 3 index funds. You can go for HDFC Index Sensex Fund. It's really performing well. You have UTI Nifty Index Fund. That's also a good fund. And the third fund I would recommend you is Tata Index Nifty Fund. Again, these are good fun. Even ICICI Prudential Nifty 50 fund is a good fund to go with. And I really hope that your query was well answered. I would say that if you are not willing to take that kind of risk, avoid broader indices and stay with the index that is well known, and good quality funds are available at this point of time, right? You must have an index fund in your portfolio. That's my recommendation for you, and all the very best with your portfolio. And on that note, have a safe and a healthy week, I would say.